Hello and welcome. In this series, we're going to navigate the often confusing world of personal finance in the United States. Our goal is simple: to empower you with the knowledge to find reliable, trustworthy financial help. It's a journey that can feel overwhelming. You see conflicting advice online, hear complex terms on the news, and it's easy to feel stuck. But finding the right guidance starts with a single, crucial step: understanding yourself. Before you can ask someone for a map, you need to know where you are and where you want to go. This chapter is all about building that foundation. Before we dive in, please remember this important disclaimer. The information provided in this audio series is for educational and informational purposes only. It is not intended to be, and should not be construed as financial, investment, legal, or tax advice. You should always consult with a qualified and licensed professional for advice tailored to your individual circumstances. Our aim here is to educate you on how to find and vet those professionals, not to replace them. So let's begin with the first and most critical task: creating a clear picture of your own financial landscape. This process can be broken down into three essential parts: defining your goals, taking a snapshot of your current situation, and understanding your feelings about risk. First, let's talk about your goals. Why are you seeking financial help in the first place? The answer to this question is deeply personal. A financial professional can't offer meaningful guidance without understanding what you want to achieve. Think of your goals in three timeframes: short-term, mid-term, and long-term. Short-term goals are things you want to accomplish within the next 1 to 3 years. This could be building an emergency fund that covers 3 to 6 months of living expenses. It might be paying off a high-interest credit card. Or maybe you're saving for a specific large purchase, like a new appliance or a vacation. Write these down. Be specific. Instead of just save money, write save $5,000 for a down payment on a reliable car. Next are your midterm goals, which typically fall in the 3 to 10-year range. This is often where bigger life events come into play. Are you hoping to buy your first home? The down payment and associated costs would be a classic midterm goal. Perhaps you're planning to start a business, or you want to save for a child's future education. These goals require more significant capital and a more structured plan. Clearly defining them now will be incredibly valuable later. Finally, we have long-term goals. These are the big picture items, usually 10 years or more into the future. For most people, the primary long-term goal is a comfortable retirement. What does that look like for you? Do you want to travel? Pursue hobbies? Live in a different city? Other long-term goals might include leaving a financial legacy for your loved ones, or achieving complete financial independence. Don't worry about having all the exact numbers right now. The key is to paint a picture of the future you're working towards. Once you have a list of your goals, the second part of our foundational work is to take an honest snapshot of your current financial situation. This isn't about judgment, it's about gathering data. There are two key components to this snapshot: your net worth and your cash flow. Let's start with net worth. It sounds complicated, but the concept is simple. It's what you own minus what you owe. First, list all your assets. These are the things you own that have value. Include the cash in your checking and savings accounts, the current value of any investment accounts like a 401k or an IRA, the estimated market value of your home if you own one, and the value of other significant assets like a car. Next, list all your liabilities. These are your debts. This includes your mortgage balance, any car loans, student loan balances, and the total amount you owe on all your credit cards. Now, subtract your total liabilities from your total assets. The number you get is your net worth. It might be positive, or it might be negative. Either way is okay. This number is not a measure of your worth as a person. It is simply a starting point, a single data point on your financial map. The second part of your financial snapshot is understanding your cash flow. This means tracking where your money comes from, and where it goes each month. Start with your total monthly income after taxes. This is the money you actually have to work with. Then track your expenses. For 1 or 2 months, keep a record of every dollar you spend. You can use a notebook, a spreadsheet, or a budgeting app. Group your expenses into categories like housing, transportation, food, utilities, debt payments, and personal spending. Be thorough. The goal is to get a realistic picture of your spending habits. When you subtract your total monthly expenses from your total monthly income, you'll see if you have a surplus or a deficit. This information is pure gold. It shows you how much you have available to put toward the goals you just defined. The third and final piece of your self-assessment is understanding your comfort level with risk, often called your risk tolerance. This is more about your psychology than about numbers. When it comes to investing and financial strategies, there's always a trade-off between risk and potential reward. Higher potential returns usually come with higher risk. Ask yourself some honest questions. How would you feel if you saw the value of your investments drop by 20% in a short period? Would you feel anxious and want to sell everything? Or would you see it as a potential buying opportunity? Understanding that markets fluctuate? There is no right or wrong answer. Some people are naturally conservative and prioritize protecting their principal. Others are more aggressive and are comfortable with volatility for the chance of higher growth. Most people fall somewhere in the middle. Knowing this about yourself helps a potential advisor understand what kind of strategies would be appropriate for you. A plan you can't stick with during tough times is not a good plan. So let's recap. Before you even start searching for a financial professional, you should have a clear document or a mental framework that includes your specific short, mid, and long-term goals, a snapshot of your current financial health through your net worth and cash flow, and an honest assessment of your personal comfort level with financial risk. Completing this homework does something incredibly powerful. It transforms you from a passive passenger into an active driver of your financial future. When you eventually sit down with a potential advisor, you won't be starting from zero. You'll be able to lead the conversation, clearly articulate your needs, and ask intelligent questions. You will be better equipped to determine if the person across the table truly understands you and is qualified to help you on your specific journey. In our next chapter, we will explore the different types of financial professionals you might encounter. We'll demystify their titles and explain what they do, so you can begin to identify which type of help might be the right fit for you. Thank you for listening. Welcome back. In our first chapter, we focused inward, building a solid foundation by understanding our own financial goals, our current situation, and our comfort with risk. Now, with that personal map in hand, it's time to look outward. We're going to explore the different kinds of financial professionals you might encounter on your journey. The world of finance is filled with a confusing array of titles and acronyms: CFP, CPA, RI, and many more. It can feel like an alphabet soup. The goal of this chapter is to demystify these titles, explain the crucial differences in how professionals operate, and help you understand what kind of expert might align with the needs you identified in Chapter 1. As always, we must begin with our important disclaimer. The information presented here is for educational and informational purposes only and should not be taken as financial, legal, or tax advice. The financial services industry is complex and regulated. Always consult with a qualified, licensed professional who can provide advice specific to your personal situation. Our purpose is to help you understand the landscape so you can navigate it more confidently. Perhaps the single most important concept to understand when evaluating financial help is the standard of care a professional is required to provide. In the U.S., there are two primary standards: the fiduciary standard and the suitability standard. The difference between them is critical. First, let's talk about the fiduciary standard. A fiduciary has a legal and ethical obligation to act in your best interest at all times. Think of it like the relationship you have with your doctor. Your doctor must recommend the treatment that is best for your health, without regard for which pharmaceutical company they might have a relationship with. Similarly, a financial professional operating under a fiduciary standard must place your financial interests ahead of their own or their firm's. They must avoid conflicts of interest, and if any exist, they must disclose them to you. Registered investment advisors, or RIAs, are one example of professionals held to this standard. On the other hand, there is the suitability standard. This standard requires that a recommendation must be suitable for your financial situation, but it doesn't have to be the absolute best option available. For example, a professional operating under this standard could recommend a mutual fund that is suitable for your risk tolerance and goals. However, there might be another, nearly identical fund with lower fees that would be a better choice for you. If the recommended fund pays the professional a higher commission, they are still meeting the suitability standard. Brokers and registered representatives of a broker-dealer often operate under this standard. Understanding this distinction gives you one of the most powerful questions you can ask a potential advisor. Are you a fiduciary, and do you adhere to the fiduciary standard 100% of the time when working with me? Now let's break down some of the common titles and credentials you'll see. First up is the Certified Financial Planner, or CFP. A CFP professional has met rigorous requirements for education, examination, experience, and ethics. They are often viewed as the general practitioners of the financial world. They typically take a holistic or big-picture view of your finances. This means they look at everything: your budget, insurance needs, investments, retirement plans, and even estate planning, to create a comprehensive financial plan. A CFP professional is required to act as a fiduciary when providing financial advice. Next is the Certified Public Accountant or CPA. Most people associate CPAs with taxes, and for good reason. CPAs are experts in tax law, tax preparation, and tax planning. They can be invaluable in helping you structure your finances in a tax-efficient way. While their primary expertise is tax, some CPAs expand their services to include financial planning and investment management, in which case they must hold the appropriate licenses. If your primary need is complex tax help, a CPA is a specialist in that area. You may also encounter a registered investment advisor, or RIA. An RIA is actually a firm, not an individual designation. These firms are registered with either the Securities and Exchange Commission, the SEC, or state securities regulators. As we mentioned, RIAs and their representatives are held to a fiduciary standard. They provide advice about securities and manage investment portfolios. The individuals who work for an RIA are called investment advisor representatives, IRs. Then there are titles like financial advisor, financial consultant, or wealth manager. It's important to know that these are general marketing titles. They are not standardized credentials, and there are no specific requirements to use them. A person calling themselves a financial advisor could be a fiduciary IR, a broker working on commission, or an insurance agent. This is why you must always look past the title and ask about their specific licenses, certifications, and the standard of care they follow. Finally, there are brokers, also known as registered representatives. They work for broker-dealer firms, and their primary function is to buy and sell securities like stocks, bonds, and mutual funds for their clients. As we discussed, they have historically been held to the suitability standard. Just as important as their title is understanding how a professional gets paid. This directly impacts the advice you might receive. There are three main models. The first is fee-only. A fee-only advisor is compensated solely by the fees they charge you directly. This could be an hourly rate for their time, a flat fee for creating a financial plan, or a percentage of the assets they manage for you, known as an AUM fee. Because they don't accept any commissions or payments from third parties for selling products, the fee-only model is designed to minimize conflicts of interest. The second model is commission-based. These professionals are paid commissions on the financial products they sell, such as mutual funds, annuities, or insurance policies. The fee is built into the product, so you may not write a direct check, but you are paying for the service through the product's costs. The third model is fee-based, which can be confusing. It sounds like fee-only, but it's a hybrid. A fee-based advisor can charge you a fee for their services, and also earn commissions on financial products they sell. They must disclose this, but it's important for you to understand that both types of compensation are possible. Knowing this, another critical question to ask is, how are you compensated? Are you fee-only, fee-based, or commission-based? By understanding the standards of care, the different professional roles, and the compensation models, you are now far better prepared to start your search. You can begin to filter out the noise and focus on finding someone whose legal obligations, expertise, and business model align with your best interests. In our next chapter, we will discuss where to actually find these professionals and the initial steps to take when vetting them. Thank you for listening. Hello and welcome back. In our first chapter, we built our personal financial foundation by looking inward. In Chapter 2, we decoded the complex world of financial professionals, learning about the critical differences in their roles, standards of care, and how they get paid. Now, armed with that essential knowledge, we are ready to take the next step, the active search. This chapter is all about where to find potential advisors and how to conduct the crucial first phase of the vetting process. Before we proceed, it is essential to restate our standing disclaimer. This audio series is for educational and informational purposes only. It is not financial, investment, legal, or tax advice. The process of choosing a financial professional is a significant decision. You should always perform your own thorough due diligence and consult with qualified, licensed professionals for advice tailored to your unique situation. So, you're ready to start building a list of potential candidates. Where do you begin? Fortunately, there are several reputable places you can start your search. Think of these not as recommendations, but as databases to begin your research. A great starting point is the online search tools provided by professional organizations. These organizations uphold specific standards for their members. For example, the CFP Board, which grants the Certified Financial Planner designation, has a Find a CFP Professional tool on its website. This allows you to search for CFPs in your area and verify their credentials. Another well-regarded organization is the National Association of Personal Financial Advisors, or NAPFA. NAPFA is an association of fee-only financial planners. Their members are committed to a fiduciary standard and a fee-only compensation model, which, as we learned, means they are paid directly by their clients, not through commissions. Their website also has a Find an Advisor search feature. If you are looking for advisors who may specialize in working with younger clients, you might explore resources like the XY Planning Network, which is a network of fee-only advisors who often focus on serving Gen X and Gen Y clients. Beyond online directories, a very common method is to ask for referrals. You might ask friends, family members, or trusted colleagues if they work with a financial professional they are happy with. A personal recommendation can feel reassuring, but it comes with a critical warning. A referral is only a name. It is not a substitute for your own vetting process. The advisor who is a perfect fit for your colleague's retirement needs may not be the right fit for your goal of starting a business. Treat any referred name with the same level of scrutiny as a name you find online. Now let's say you have a short list of names. Before you even think about picking up the phone or sending an email, it's time for the single most important step in the vetting process: the background check. Thanks to regulatory bodies in the United States, you can do this for free from the comfort of your own home. Your first stop should be a tool called BrokerCheck, which is operated by FINRA, the Financial Industry Regulatory Authority. FINRA is a government-authorized not-for-profit organization that oversees U.S. broker-dealers. BrokerCheck is a free tool that allows you to research the professional history of brokers, brokerage firms, and individual investment advisor representatives. When you look up a professional on BrokerCheck, you will find a wealth of information. You'll see a history of their employment, the exams they have passed, and their state licenses. Most importantly, you will see a section for disclosures. This is where you will find information about any customer disputes, regulatory actions, criminal convictions, or other disciplinary events. Reviewing this report is non-negotiable. A clean record is a basic requirement. Your second stop for due diligence is the Investment Advisor Public Disclosure website, or IPD, which is run by the Securities and Exchange Commission, the SEC. This database contains registration documents for registered investment advisor firms and the people who work for them. The key document to look for here is the Form ADV. The Form ADV is a disclosure document that every RIA must file. It contains information about the firm's business practices, their fee schedule, their investment philosophy, and, like BrokerCheck, any disciplinary history. Part 2 of the Form ADV, often called the brochure, is written in plain English and provides a detailed narrative about the firm. Reading this document can give you incredible insight into how an advisor operates before you ever speak with them. Once you have vetted your short list of candidates and confirmed they have clean regulatory records, it's time to prepare for first contact. Begin by visiting their professional website. Read their blog, look at the services they offer, and try to get a feel for their philosophy. Who is their typical client? Do they specialize in working with people like you, for example, retirees, young families, or small business owners? Does their communication style seem clear and approachable? Based on this research and what we learned in the last chapter, start to compile a list of questions for an initial phone call or introductory meeting. This is your interview script. You are the one in the hiring position. Your questions should include: are you a fiduciary, and do you act in a fiduciary capacity at all times when working with clients? How are you compensated? Are you fee-only, fee-based, or commission-based? What are your specific qualifications, credentials, and licenses? Could you describe your ideal or typical client? What is your overall investment philosophy? The goal of this first contact is not to make a decision. The goal is to determine if there is a potential fit. It's a chemistry check. Do they listen to you? Do they answer your questions directly and clearly, or do they use confusing jargon? Do you feel comfortable and respected? To recap this chapter's process, you start by building a list of names from reputable sources like professional organizations. Then, before making contact, you conduct a thorough background check using FINRA's BrokerCheck and the SEC's IPD website. Finally, you prepare a thoughtful set of questions for an initial introductory call. By following these steps methodically, you build a strong defense against potential issues and move confidently toward finding a trustworthy partner. In our next chapter, we will focus entirely on that first meeting. We'll detail the essential questions to ask and the red flags to watch for, helping you make an informed and careful decision. Thank you for listening. Hello, and welcome back to our series on finding reliable financial help. So far, we have laid all the essential groundwork. In Chapter 1, we created our personal financial blueprint. In Chapter 2, we demystified the various types of financial professionals. And in Chapter 3, we learned how to find and conduct initial background checks on potential advisors. Now we've arrived at a pivotal moment. The first meeting. Think of this meeting as a job interview, but with a twist. You are the one conducting it. You are the employer, and you are deciding whether to hire this person for one of the most important roles in your life. The goal isn't to get specific investment picks or a full financial plan on the spot. The goal is to determine if this professional has the expertise, process, and character to be your trusted partner. This chapter is dedicated to the key questions you should ask and the critical red flags you must watch out for. As we always do, let's begin with our important reminder. This content is for educational and informational purposes only and is not a substitute for professional financial, legal, or tax advice. The questions and red flags discussed here are intended as a general guide to help you in your own due diligence process. By now, you've already confirmed the basics, like their fiduciary status and compensation model. In this meeting, it's time to dig deeper into their process and philosophy. Let's start with questions about their services and what it's like to be their client. You might ask, can you walk me through your financial planning process from start to finish? A good advisor should have a clear, structured process they can easily explain, from gathering your data to presenting a plan and implementing it. Another crucial question is about communication. How often will we communicate, and what form will that take? Will there be quarterly review meetings? Will you receive monthly statements? Are they available for phone calls if you have a quick question? Understanding their communication protocol upfront prevents future frustration and ensures you feel supported. Next, inquire about their philosophy. Ask, could you describe your overall philosophy on investing and financial planning? There's no single correct answer here. You're listening for an approach that aligns with your own values and the risk tolerance you identified in Chapter 1. Do they believe in active, hands-on trading? Or do they prefer a more passive, long-term approach? Hearing them describe this in their own words is incredibly insightful. It's also wise to ask about their specialization. A great question is, who is your typical client? If their answer describes someone in a very different financial situation or life stage than you, they may not be the best fit, even if they are a skilled professional. If you are a young family saving for college, an advisor who primarily works with multi-million-dollar estates might not have the focused expertise you need. Finally, ask a critical structural question. Where will my money be held? A reputable advisor will use a large independent, third-party firm known as a custodian. Examples include well-known names like Charles Schwab, Fidelity, or TD Ameritrade. The custodian is responsible for the safekeeping of your assets. Your account should be in your name at the custodian, and you should receive statements directly from them. This separation of duties is a crucial safeguard for your money. An advisor should never ask you to make a check for an investment payable directly to them or their firm. Just as important as asking the right questions is knowing how to spot potential red flags. These are warning signs that should cause you to pause and proceed with extreme caution. The first red flag is any kind of high-pressure sales tactic. If a professional says something like, "This special opportunity is only available if you sign up today," or makes you feel rushed, that is a signal to walk away. A true professional will encourage you to take your time, think it over, and feel completely comfortable before moving forward. The second, and perhaps most dangerous, red flag is any promise of guaranteed, high returns. All investing involves risk. Any person who guarantees high returns with little or no risk is either fundamentally misunderstanding how markets work or is being dishonest. This is a hallmark of potential scams. Third, watch out for a lack of transparency. If you ask a direct question about fees, conflicts of interest, or their disciplinary history, and you receive a vague, confusing, or dismissive answer, consider it a major red flag. Trust is built on transparency, and a professional who is not forthcoming with basic information is not someone you should trust with your finances. A fourth red flag is a one-size-fits-all approach. If the advisor starts recommending specific products or strategies before they've asked you extensive questions about your personal goals, income, debts, and feelings about risk, they are not doing their job. A good plan is customized to you, not pulled off a shelf. Lastly, pay attention to the quality of communication. Do they use excessive jargon without explaining it? Do they listen more than they talk? Do you feel like your concerns are being heard and respected? Or do you feel like you're being talked down to? This professional relationship may last for decades, so a foundation of clear, respectful communication is absolutely essential. After the meeting, take some time to reflect. It's perfectly acceptable, and often advisable, to interview 2 or 3 different professionals before making a decision. This allows you to compare their approaches, fees, and personalities. In our next chapter, we will discuss what happens once you've made your choice. We'll cover the process of formalizing the relationship, understanding the key documents you'll be asked to sign, and how to set the stage for a successful, long-term partnership. Thank you for listening. Hello and welcome back. In our journey so far, we have done the internal work of defining our goals. We have learned to identify different types of financial professionals, we have researched their backgrounds, and we have successfully navigated the first interview. You've asked the tough questions, watched for red flags, and now, you've selected a professional you believe is the right fit. The next step is to make the relationship official. This chapter is about what that process looks like, understanding the key documents you'll sign, the policies that will guide your relationship, and how to set the stage for a successful, long-term partnership. As we move into this more formal stage, our guiding principle remains the same, and so does our disclaimer. This information is for educational purposes only. It is not legal or financial advice. The documents discussed are legally binding contracts. It is vital that you read them thoroughly and consider asking questions about anything you do not understand before signing. A trustworthy advisor will expect and welcome this level of diligence. Once you've verbally agreed to work with an advisor, the onboarding process begins. This will involve several key documents designed to formalize your relationship and outline exactly how your money will be managed. The first, and one of the most important, is the Investment Advisory Agreement. This is the legal contract between you and the advisory firm. It spells out the terms of your relationship. While the specifics can vary, this agreement will typically detail the scope of the services to be provided. Will the advisor be managing your investments, creating a comprehensive financial plan, or both? It will clearly state the fee structure, how much you will pay, how it is calculated, and when it will be billed. The agreement will also define the advisor's authority. For example, it will specify whether you are giving them discretionary authority, which allows them to make trades on your behalf without prior approval for each one, or non-discretionary authority, which requires your consent for every transaction. Read this document carefully. It is the rulebook for your entire engagement. Another critical document that a thorough advisor will work with you to create is the Investment Policy Statement, or IPS. Think of the IPS as the constitution for your portfolio. It's a written document that outlines the strategic plan for your investments, connecting the goals you established in Chapter 1 to the actions the advisor will take. An IPS typically includes your financial objectives, like saving for retirement or a child's education. It will define your risk tolerance, which we discussed earlier. It will also outline the target asset allocation, the mix of different types of investments, such as stocks and bonds, that will be used. Furthermore, it sets the criteria for how and when the portfolio will be reviewed and rebalanced. The IPS is a powerful tool. It keeps both you and your advisor accountable and helps prevent emotional, short-sighted decisions during periods of market volatility. It ensures that all actions are guided by your pre-established, long-term strategy. In addition to the advisory agreement and the IPS, you will complete account opening paperwork. As we discussed in the last chapter, your assets should be held at a separate, third-party custodian. Therefore, you will be opening an account in your name at that custodial institution. This paperwork will feel similar to opening a bank account. You will provide personal information, designate beneficiaries for the account, and formally grant your advisor the authority to manage the assets within that account. You should receive welcome materials and online access directly from the custodian. This allows you to view your accounts and receive statements independently of your advisor, providing an essential layer of transparency and security. As you go through this onboarding process, remember that a good advisor's team should guide you through each step. They should explain the purpose of each form and answer all your questions patiently and clearly. If you feel rushed, confused, or pressured at any point during the paperwork phase, it is a significant red flag. This is a time for clarity and precision, not speed. Once the accounts are open and the agreements are signed, the real partnership begins. The initial work will involve implementing the strategy laid out in your investment policy statement. This might involve transferring assets from old accounts and investing them according to your new plan. But the work doesn't stop there. A financial advisory relationship is not a one-time event. It's an ongoing process. Your life will change. You might change jobs, have children, receive an inheritance, or approach retirement. Your financial plan needs to be a living document that can adapt to these changes. A reliable advisor will have a structured process for regular check-ins and reviews to ensure your plan remains aligned with your life.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
The foundation of trust you build during the search and onboarding process is what will carry you through these future conversations and decisions. In our next chapter, we'll shift our focus to an equally important topic: understanding the basics of common financial products and investment types. This knowledge will help you have more informed conversations with your advisor and better understand the strategy they are implementing for you. Thank you for listening. Hello and welcome back. In our last chapter, we walked through the process of making your relationship with a financial advisor official, covering the key documents that form the foundation of your partnership. With that structure in place, your advisor will begin to implement the strategy outlined in your investment policy statement. To be an engaged and informed partner in this process, it's helpful to understand the basic building blocks they might use. This chapter is a plain English guide to the most common types of investments. Our goal is not to tell you what to invest in, but to demystify the terms you will hear, so you can have more confident and productive conversations with your professional guide. Before we dive in, we must restate our most important message. This chapter provides general, educational information about financial products and concepts. It is not investment advice and should not be interpreted as a recommendation to buy or sell any security. All investments carry risk, including the possible loss of principal. Investment decisions should only be made in consultation with a qualified and licensed professional who understands your complete financial situation. At the highest level, most investment portfolios are built on two core asset classes: stocks and bonds. Let's start with stocks, which are also known as equities. When you buy a share of stock, you are buying a small piece of ownership in a publicly traded company. Imagine a large pizza that is cut into millions of tiny slices. Buying one share of stock is like buying one of those slices. You are now a part owner of the company. If the company does well, its profits grow and its future looks bright, the value of your slice, or your share, may increase. This is called capital appreciation. Additionally, some companies choose to distribute a portion of their profits to their owners, the shareholders. This payment is called a dividend. Stocks are generally sought after for their potential for growth over the long term, but they also come with a higher level of risk and price volatility. The value of your ownership slice can go down just as easily as it can go up. The other core asset class is bonds, also known as fixed income. If buying a stock is like being an owner, buying a bond is like being a lender. You are essentially loaning money to an entity, which could be a corporation or a government body, like a city or the federal government. In exchange for your loan, the issuer of the bond promises to pay you periodic interest payments over a set term. At the end of that term, known as the bond's maturity date, the issuer repays the original amount of the loan, called the principal. Because they are structured as loans with defined payment schedules, bonds are generally considered to be less risky than stocks. However, they typically offer lower potential returns in exchange for that relative stability. Now, while it's possible to buy individual stocks and bonds, most people invest in them through pooled investment vehicles. The two most common types are mutual funds and exchange-traded funds, or ETFs. A mutual fund is a company that pools money from many different investors. It then uses that large pool of money to buy a diversified portfolio of hundreds, or even thousands of individual stocks, bonds, or other assets. This portfolio is managed by a professional fund manager or a team of managers. When you invest in a mutual fund, you are buying a share of the entire fund, which gives you instant diversification across all its holdings. Think of it like buying one share in a large, pre-made basket of different goods. The value of your mutual fund share, called its net asset value or NAV, is calculated once per day after the market closes. Exchange-traded funds, or ETFs, are similar to mutual funds in that they also represent a basket of securities, providing diversification. However, there is a key structural difference. ETFs trade on a stock exchange throughout the day, just like an individual stock. This means their price can fluctuate from moment to moment while the markets are open. Many ETFs are designed to be passively managed, which means they don't have a manager actively trying to pick winning investments. Instead, the fund is structured to simply track the performance of a specific market index, like the S&P 500, which represents 500 of the largest U.S. companies. This is known as index investing. Understanding these building blocks, stocks, bonds, mutual funds, and ETFs, helps you understand a fundamental concept of investing: diversification. You've likely heard the old saying, "Don't put all your eggs in one basket." That is the core idea of diversification. It means spreading your investments across different types of assets. The purpose of this strategy is to help manage risk. The idea is that by owning a mix of different investments, the poor performance of one part of your portfolio may be offset by the better performance of another part. It's important to remember that diversification is a strategy to manage risk, not to eliminate it entirely. With this foundational knowledge, you are now better equipped to understand the investment strategy your advisor develops for you. You can ask more informed questions and more clearly comprehend the purpose of each component within your portfolio. In our next chapter, we will discuss the different types of accounts where these investments are typically held. We'll explore the purpose and general rules of retirement accounts like 401k, and IRAs, as well as standard taxable brokerage accounts. Thank you for listening. Hello and welcome back. In our last chapter, we looked at the building blocks of a portfolio: investments like stocks, bonds, mutual funds, and ETFs. Now, we're going to talk about the toolboxes where those building blocks are kept. These toolboxes are the different types of financial accounts, and each one is designed for a specific purpose and has its own set of rules, particularly when it comes to taxes. Understanding the purpose of each account will help you better appreciate the structure of your financial plan. As we are about to discuss topics that touch upon tax regulations, our disclaimer is more important than ever. The information provided here is for general educational purposes only. It is not tax, legal, or investment advice. Tax laws are complex and subject to change. The choice of which account to use has significant financial and legal implications. You should always consult with a qualified financial advisor or tax professional to determine what is appropriate for your individual situation. In the United States, investment accounts can generally be sorted into two broad categories: tax-advantaged accounts, which are primarily designed for retirement, and taxable accounts, which are used for general investment purposes. Let's start with tax-advantaged retirement accounts. The U.S. government provides these accounts to encourage people to save for the long term. The tax advantage comes in different forms, but the goal is to help your money grow more efficiently over many years. The most common type is the 401k plan. This is an employer-sponsored retirement plan. If your employer offers one, you can elect to have a portion of your paycheck automatically contributed to the account. One of the most powerful features of many 401k plans is the employer match. This means your employer will contribute money to your account alongside your own contributions, up to a certain percentage of your salary. This is a key part of the benefits package at many companies. Within a 401k, you might have two choices for how your money is treated for tax purposes: traditional and Roth. A traditional 401k allows for pre-tax contributions. This means the money goes into your account before income taxes are calculated on your paycheck, which can lower your taxable income for the year. The investments grow tax-deferred, and you pay income tax on the money when you withdraw it in retirement. A Roth 401k, on the other hand, is funded with after-tax contributions. You don't get an immediate tax deduction, but your investments grow tax-free, and qualified withdrawals in retirement are also tax-free. The other major type of retirement account is an individual retirement arrangement, or IRA. As the name suggests, this is an account that you open on your own, separate from an employer. Like a 401k, IRAs also come in traditional and Roth varieties, and they operate on the same tax principles. A traditional IRA may allow you to deduct your contributions from your taxes today, with the money growing tax-deferred until you pay taxes on withdrawals in retirement. A Roth IRA is funded with after-tax dollars, offering no upfront deduction, but providing for tax-free growth and tax-free qualified withdrawals in retirement. Both 401k and IRAs have annual contribution limits set by the IRS and have rules regarding when you can withdraw the money, typically after reaching retirement age. Now let's talk about the other main category: the taxable brokerage account. A taxable brokerage account, sometimes just called an investment account, is a general-purpose tool for investing. Unlike retirement accounts, there are no special tax benefits. The money you put in is after-tax money. There are no annual limits on how much you can contribute, and there are no restrictions from the government on when you can withdraw your funds. Because it lacks the tax advantages, any income generated in the account is typically taxed each year. For example, if you receive dividends from stocks you own, that is generally considered taxable income for that year. Furthermore, if you sell an investment for a higher price than you paid for it, that profit is called a capital gain, and you will generally owe capital gains tax on it. The flexibility to access your money at any time makes these accounts suitable for financial goals that fall outside of retirement, such as saving for a home down payment or other major purchases. To summarize, think of these accounts as different tools for different jobs. Tax-advantaged retirement accounts like 401k, and IRAs are specialized tools designed for the long-term goal of retirement, offering significant tax benefits as an incentive. Taxable brokerage accounts are more like a multi-purpose tool, offering maximum flexibility for various goals, but without the same tax incentives. A comprehensive financial plan, as developed by a professional, will often use a combination of these accounts to address your various goals in the most effective way. In our next chapter, we will turn our attention to another critical and often overlooked component of a sound financial plan: risk management and the role of insurance. Thank you for listening. Hello and welcome back. Thus far in our series, we have focused on building your financial future, setting goals, finding help, and understanding the tools of investing. But a crucial part of any sound financial plan isn't just about growth, it's about protection. A solid foundation must be able to withstand unexpected shocks. This chapter is dedicated to the concept of risk management, which is a formal way of saying preparing for the unexpected. We'll explore the role of insurance as a primary tool for protecting you and your loved ones from catastrophic financial loss. As we are discussing products that are a core part of the health and financial industries, our disclaimer is critically important. This chapter provides general, high-level educational information about the purpose of different types of insurance. It is not, and should not be considered financial, legal, or health advice. The world of insurance is complex and highly regulated. Determining the appropriate type and amount of coverage is a deeply personal decision that should only be made after a thorough needs analysis with a qualified, licensed insurance professional or financial advisor. Think of risk management as a financial safety net. There are certain life events that, while unlikely on any given day, would have a devastating financial impact if they were to occur. The fundamental purpose of insurance is to transfer the financial burden of these catastrophic events from you to an insurance company. In exchange for a regular payment, known as a premium, the insurance company agrees to pay a much larger sum, the benefit, if a specified event occurs. Let's talk about the purpose of some of the most common types of insurance. First is life insurance. The primary purpose of life insurance is to provide financial support for your dependents if you were to pass away unexpectedly. It is not about making someone wealthy. It is about preventing a financial crisis for those who rely on your income. The benefit can be used to replace lost income, pay off a mortgage, cover children's education costs, or simply provide the resources for your family to maintain their standard of living during a difficult time. In the U.S., there are two very broad categories of life insurance. Term life insurance provides coverage for a specific period, or term, such as 20 or 30 years. Permanent life insurance, such as whole life, provides lifelong coverage and includes a cash value component that can grow over time. Each is structured to serve different long-term financial planning objectives. Next is disability insurance. Many people consider their most valuable asset to be their home or their investments, but for most working individuals, the single most valuable asset is their ability to earn an income. Disability insurance is designed to protect that asset. If you become ill or injured and are unable to work for an extended period, disability insurance provides you with a portion of your income. It is essentially paycheck protection. This allows you to continue paying your bills and meeting your financial obligations while you focus on your recovery, without having to deplete your long-term savings or retirement accounts. Then there is health insurance. In the United States, health insurance is a cornerstone of financial security. Its purpose is to cover the costs of medical care, from routine doctor visits to major surgeries and hospital stays. Without adequate health insurance, a major illness or accident could lead to overwhelming medical debt, which is a leading cause of personal bankruptcy in the country. It is a tool for both physical and financial well-being. Another important type of protection, particularly as you plan for later in life, is long-term care insurance. This is different from health insurance. Long-term care insurance is designed to cover the costs of services for individuals who can no longer perform certain activities of daily living on their own, such as bathing, dressing, or eating. This care can be provided in a variety of settings, including in your own home, in an assisted living facility, or in a nursing home. These costs can be substantial, and long-term care insurance is one tool people use to protect their retirement assets from being exhausted by these expenses. Finally, we have the types of insurance most people are familiar with: property and casualty insurance, which includes auto and homeowners insurance. The purpose is straightforward. to protect the value of your significant physical assets from damage or loss due to accidents, theft, or other covered events. Each of these types of insurance serves as a different thread in your financial safety net. A financial plan that focuses only on accumulating assets without protecting them is like building a beautiful house with no locks on the doors. A proper risk management strategy, developed with a professional, helps ensure that an unexpected life event doesn't derail the long-term financial goals you have worked so hard to set. In our next chapter, we will begin to tie these concepts together by discussing the basics of creating a holistic financial plan. Thank you for listening. Hello and welcome back to our series. Over the last several chapters, we have explored the essential individual components of a healthy financial life. We started with the internal work of setting goals, then moved on to finding professional help, understanding investments, and finally, protecting our foundation with risk management. Now it's time to see how a qualified professional brings all those pieces together into a single, cohesive strategy. This is what's known as a holistic financial plan. This chapter will explain what a holistic plan is and what its key components are, giving you a clear picture of the roadmap you and your advisor will build together. As we are bringing together multiple financial, investment, and risk management concepts, our standing disclaimer is as important as ever. This audio is for educational purposes only. It is not a substitute for personalized financial, legal, tax, or investment advice. A financial plan is a complex document tailored to an individual's specific circumstances. The concepts discussed here are for informational purposes to help you understand the process when working with a qualified professional. So, what does the word holistic mean in this context? It means looking at the whole picture. A holistic financial plan doesn't just look at your investments in isolation. It considers every aspect of your financial life and understands how each part affects the others. Think of it like a visit to a great doctor. They don't just treat a single symptom. They consider your entire health, your diet, exercise, stress levels, and family history to create a comprehensive wellness plan. Similarly, a holistic financial plan coordinates your cash flow, investments, insurance, retirement savings, and other financial elements into one integrated strategy. A comprehensive financial plan typically addresses several key areas. Let's walk through them, and you'll see how they connect to our previous chapters. The first and most important component is the foundation, your goals and your cash flow. As we discussed in Chapter 1, a plan without a goal is just a set of random actions. The plan will clearly state your short, mid, and long-term objectives. It will also be based on a realistic understanding of your income and expenses, identifying the resources you have available to allocate toward those goals. The second component is the growth engine, your investment strategy. Based on your goals and your personal risk tolerance, the plan will outline a detailed investment strategy. As we covered in Chapters 6 and 7, this will specify the types of investments and accounts that will be used. It will define a target asset allocation, the mix of stocks, bonds, and other assets, designed to provide the potential growth needed to reach your objectives over the appropriate time horizon. The third component is your protective shield, a risk management plan. A financial plan must account for life's uncertainties. As we explored in Chapter 8, this involves reviewing your insurance coverage. The plan will help identify your potential exposure to catastrophic financial loss from events like a premature death, a disability, or a major health issue, ensuring that your financial safety net is properly in place to protect your assets and your family. Fourth is a detailed retirement plan. For many people, this is the centerpiece of the entire financial plan. It goes beyond simply saving in a 401k. A good retirement plan will project your estimated expenses in retirement, calculate how much capital you will need to accumulate to support that spending, and create a savings and investment plan to help you get there. It brings all the pieces together, your savings rate, investment strategy, and risk management, to focus on that one critical long-term goal. Finally, a truly holistic plan will touch upon the concept of estate planning. This is an area where a financial advisor and a legal professional often collaborate. It's important to be very clear. Estate planning involves legal decisions and documents, and you must consult a qualified attorney for legal advice. From a financial planning perspective, the goal is to ensure your assets are managed and distributed according to your wishes in the event of your death or incapacitation. A financial advisor can help you organize your financial information and think through your goals, but an attorney is the one who drafts critical legal documents. These documents can include a will, which outlines how your property should be distributed, and powers of attorney for healthcare and finances, which designate someone to make decisions for you if you are unable to do so yourself. A key takeaway is that a financial plan is not a static document that you create once and then file away. It is a living document. Life happens. You get married, change careers, have children, or experience other significant events. A good financial plan should be reviewed regularly, typically at least once a year, and updated to reflect the changes in your life. This ongoing process is a central part of a healthy, long-term relationship with your advisor. In our next chapter, we will explore the human side of money, behavioral finance, and understanding the common psychological biases that can influence our financial decisions. Thank you for listening. Hello and welcome back. In our last chapter, we brought together all the technical pieces of a financial strategy into a single holistic plan. But a plan is only as good as our ability to stick with it. We are not robots. We are human beings, driven by a complex mix of logic and emotion. This chapter delves into that human side of money. We're going to explore the fascinating field of behavioral finance, which is the study of how psychology impacts our financial decisions. Understanding these concepts can help you recognize your own tendencies and make more rational, thoughtful choices. As always, we must begin with our disclaimer. The information presented here is for educational and informational purposes only. It is a general discussion of psychological concepts, not financial or investment advice. The goal of this chapter is to promote self-awareness, which can be a valuable tool when working with the qualified financial professional you have chosen to guide you. For a long time, traditional economic theories assumed that people always make logical, rational financial decisions. But if we're honest with ourselves, we know that's not always true. We are influenced by fear, excitement, and the opinions of others. Behavioral finance helps us understand why. Let's explore a few of the most common behavioral biases that can affect us. The first is called loss aversion. Psychologically, the pain of losing is about twice as powerful as the pleasure of an equivalent gain. For example, the happiness you might feel from finding a $100 bill is much less intense than the distress you would feel from losing a $100 bill. In investing, this can lead to a behavior known as getting even. An investor might hold on to a losing investment long after it has become clear it was a poor choice, simply because selling it would mean realizing or making the loss official. They hold on, hoping it will come back to their break-even point, even if that means missing out on better opportunities elsewhere. The fear of locking in a loss overrides the rational decision to move on. Another powerful bias is herding. As social creatures, we have a natural instinct to follow the crowd. We assume that if a large number of people are doing something, it must be the right thing to do. In the financial world, this can manifest as chasing hot stocks or speculative trends. When a particular investment is all over the news and everyone seems to be getting rich from it, the fear of missing out, or FOMO, can be overwhelming. The herding instinct can cause people to invest at the peak of a bubble, often without fully understanding what they are buying, simply because everyone else is doing it. A disciplined financial plan helps counteract this by grounding your decisions in your personal goals, not in the momentary panic or euphoria of the crowd. Next, let's talk about confirmation bias. This is the natural human tendency to search for, interpret, and favor information that confirms our pre-existing beliefs. Once we've made a decision, like buying a particular stock, we subconsciously want to be proven right. So, we might spend our time reading positive news articles about that company while dismissing or ignoring any negative reports. This creates an echo chamber that reinforces our initial decision, potentially blinding us to new risks or changing fundamentals that a rational observer would see. It's a bias that makes it very difficult to admit we might have made a mistake. Finally, there is overconfidence bias. This is the tendency for people to be more confident in their own abilities than is objectively reasonable. In finance, this can lead someone to believe that they can consistently time the market. That is, sell right before it goes down and buy right before it goes up. Or it might lead them to think they can pick individual winning stocks better than professional analysts. While confidence is a good trait, overconfidence in the realm of investing can lead to excessive trading, taking on too much risk, and failing to properly diversify, as the person believes their superior knowledge protects them from loss. These are just a few examples, but they illustrate a crucial point. These biases are not character flaws. They are a normal part of human psychology. Everyone is susceptible to them. The key is awareness. By knowing that these tendencies exist, you can start to recognize them in your own thinking. This is one of the most valuable roles of a holistic financial plan and a good advisor. The plan provides a logical, predetermined course of action. The advisor can act as an objective third-party coach, helping you stick to that plan when your emotions might be telling you to do otherwise. They can help you navigate market volatility by reminding you of your long-term goals, providing a buffer between your emotions and your money. In our next chapter, we will discuss the importance of regular financial checkups and how to measure the progress of your financial plan over time. Thank you for listening. Hello and welcome back. In our last chapter, we explored the psychological side of money, the behavioral biases that can steer us off course. We learned that emotion and instinct can often be the biggest obstacles to a successful financial journey. So, what is the antidote? It is process and discipline. This chapter is about establishing a routine for a regular financial checkup. Just like you visit a doctor for an annual wellness exam to ensure your health is on track, a financial checkup ensures your financial plan remains healthy and aligned with your life. As always, we must begin with our standing disclaimer. This information is for educational purposes only and is not a substitute for professional financial or investment advice. The concepts discussed here are intended to provide a framework for the review process you will undertake with your qualified financial professional. The metrics of success for any plan are deeply personal and should be evaluated based on your unique goals. The primary purpose of a financial checkup is not to react to the daily noise of the stock market. Instead, it is a proactive process to ensure your financial plan, which we discussed in Chapter 9, is still a good fit for your life. Life is not static. Your income can change, your family can grow, and your goals can evolve. A regular review process ensures that your financial strategy evolves with you. It is also a powerful tool to combat the behavioral biases we just learned about. By scheduling a time to review your plan logically, you are less likely to make impulsive decisions based on fear or greed. So, when should you conduct these reviews? Most professionals recommend a comprehensive review at least once a year. This is a dedicated meeting with your advisor to go over every aspect of your plan in detail. However, an annual review is just the minimum. It is also critical to initiate a checkup after any major life event. This could include getting married or divorced, having a child, changing jobs or receiving a significant salary increase, buying a home, or receiving an inheritance. Any of these events can have a profound impact on your financial picture and may require adjustments to your plan. Now, what exactly should be on the agenda for this checkup? Let's break down the key areas to cover. First, you must revisit your goals. This is the foundation of your entire plan. Are the goals you established in Chapter 1 still your priorities? Have your timelines changed? For example, perhaps you initially planned to retire at age 65, but now you are considering retiring a few years earlier. Or maybe a new goal, like starting a small business, has appeared on your radar. The review is the time to have these conversations so your advisor can adjust the plan accordingly. Second, review your cash flow and budget. Look at your income and expenses over the past year. Did your spending align with your plan? Has your income changed? This is a practical check to ensure your savings rate is still on track to fund your goals. Without positive cash flow, even the best investment strategy will fail. Third, you will assess your investment portfolio. This is an area where it is crucial to maintain the right perspective. Hello and welcome back. In our last chapter, we established the importance of a disciplined, regular financial checkup to keep your plan on track. But life doesn't always wait for your scheduled annual review. Along your journey, you will likely encounter major life events that can significantly alter your financial landscape overnight. These moments are the critical junctures where being proactive is key. This chapter is about identifying those major life events and understanding the important financial conversations they should immediately trigger with your professional advisor. Before we explore these scenarios, we must reinforce our guiding principle with this disclaimer. The information presented here is for general educational purposes to help you identify moments of financial complexity. It is not financial, legal, or tax advice for any specific life situation. Every individual's circumstances are unique. The goal is to empower you to know when it's time to pick up the phone and engage the professional team you've built. Think of your advisor not just as someone you meet with on a schedule, but as a thinking partner who can provide clarity during life's biggest transitions. Let's walk through some of the most common events. First, getting married or entering a committed partnership. This is one of the most significant financial events in life, as it involves the merging of two financial worlds. Suddenly, it's not just about my money or your money, but often about our money. This transition raises immediate questions. How will you and your partner manage household cash flow? Will you use joint bank accounts, separate accounts, or a combination? How do you align on your financial goals, which may have been different when you were single? You also need to review and update the beneficiaries on all your accounts, from retirement plans like 401k, and IRAs to life insurance policies. This is a perfect time to work with your advisor to facilitate a healthy conversation.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
And build a new, joint financial plan. Next, having a child or expanding your family. Welcoming a new child into your life is a joyous occasion, and it also brings a host of new financial responsibilities. Your day-to-day budget will change immediately. This is a time to revisit your cash flow and create a new spending plan. Your risk management needs will likely increase, prompting a review of your life insurance and disability insurance coverage to ensure your family is protected. And of course, you may start thinking about long-term goals like saving for college education. An advisor can help you explore the various types of education savings accounts and integrate this new goal into your overall plan. Another common event is changing jobs or starting a business. A new job often means a different salary, a new benefits package, and a new retirement plan. One of the most common questions that arises is what to do with the 401k from your old employer. Your advisor can explain the pros and cons of your options, such as rolling it over into an IRA or into your new employer's plan. If you are starting a business, the financial complexity increases even more. You'll need to plan for irregular income, manage business expenses, and understand your new tax obligations, which often requires collaboration between your financial advisor and a CPA. Let's talk about buying a home. For most people, this is the single largest purchase they will ever make. It's more than just a place to live, it's a massive financial commitment. Before you even start looking, a conversation with your advisor is crucial to determine how a mortgage payment will fit into your long-term financial plan. They can help you think through the total costs of homeownership beyond the mortgage, including property taxes, insurance, and ongoing maintenance, ensuring that your dream home supports, rather than hinders, your other financial goals. Finally, consider the event of receiving an inheritance or another type of financial windfall. While this may seem like a purely positive event, a sudden influx of money can be emotionally overwhelming and financially complex. It often brings immediate questions about potential taxes, which is a conversation for a tax professional. From a planning perspective, the key is to be deliberate. An advisor can help you pause and think through how these new assets can best be used to accelerate your progress toward your long-term goals. Rather than simply being spent, they can help you integrate the windfall into your financial plan in a thoughtful, strategic way. In all these scenarios, the common theme is change. When your life changes, your financial plan must be reviewed. By recognizing these events as triggers for a conversation, you move from being reactive to proactive, ensuring your financial plan remains a relevant and powerful tool for your entire life. In our next chapter, we will focus on one of the most significant long-term goals for most people: planning for retirement. Thank you for listening. Hello and welcome back. Throughout this series, we have discussed goals, investments, risk management, and major life events. For many people, all of these topics ultimately converge on one overarching objective: planning for a comfortable and dignified retirement. Retirement is not just an end to your working career. It is the beginning of a new chapter in your life. This chapter will break down the fundamental concepts of retirement planning, framing it not as a single, intimidating number, but as a series of thoughtful questions and strategic steps you can explore with your advisor. As we are about to discuss one of the most significant long-term financial goals, our disclaimer is essential. The information provided here is for general educational purposes only. It is not financial, tax, or investment advice. Retirement planning is a deeply personal and complex process. The right strategy for you depends entirely on your unique circumstances and should be developed in close consultation with a qualified financial professional. The first step in any retirement plan has nothing to do with numbers. It starts with a vision. Before you can plan a journey, you must have a destination in mind. What does retirement look like for you? This is a creative exercise. Ask yourself some key questions. At what age do you hope to retire? Where do you want to live? Will you stay in your current home, downsize, or perhaps move to a different climate? What will you do with your newfound free time? Do you envision traveling the world, pursuing hobbies, volunteering, or even working part-time in a field you love? Answering these qualitative questions is the foundation upon which the entire financial structure of your retirement will be built. Once you have a clearer vision, you can move to the big quantitative question. How much money is enough? There is no universal answer or magic number. The answer is unique to you and your vision. The process of finding that answer, which a financial professional facilitates, involves a few key concepts. First is estimating your retirement spending. Based on the lifestyle you envisioned, you'll work to project your annual expenses in retirement. Next comes the concept of inflation. A dollar today will not have the same purchasing power in 20 or 30 years. A retirement plan must account for the rising cost of goods and services over time to ensure your income keeps pace. Using sophisticated financial modeling tools, a professional can then calculate the approximate lump sum of capital you would need on your retirement date to generate your desired income stream for the rest of your life. So where will that income come from? In the United States, retirement income is often described using the analogy of a three-legged stool. Each leg represents a different potential source of funding. The first leg is Social Security. This is a federal program that provides a baseline of income for eligible retired workers. The amount you receive depends on your earnings history and the age at which you decide to begin claiming benefits. A key part of retirement planning is developing a strategy for when and how to claim your Social Security benefits to best support your overall plan. The second leg of the stool is employer-sponsored retirement plans. Historically, this included pensions, which provided a guaranteed monthly income. Today, it more commonly refers to defined contribution plans like the 401k, and 403b, as we discussed in an earlier chapter. In these plans, you and potentially your employer contribute to an investment account that grows over your career. Upon retirement, this accumulated sum becomes a primary source of your income. The third leg is your personal savings and investments. This includes the individual retirement arrangements, or IRAs, and the taxable brokerage accounts that you own and control directly. For many people, this leg is the most critical because it is the one over which they have the most control throughout their lives. The consistency and amount of your personal savings can make a profound difference in your ability to reach your retirement goals. Everything we've discussed so far relates to the accumulation phase, the years you spend working and saving. But a complete retirement plan also has a strategy for the distribution phase, which is the period when you are no longer earning an income and must live off your accumulated assets. This involves creating a sustainable withdrawal strategy, determining the most tax-efficient way to draw income from your various accounts, and ensuring your portfolio is structured to last for a lifetime that could be 30 years or longer. This is one of the most complex challenges in financial planning and highlights the value of ongoing professional guidance. In summary, retirement planning is a dynamic, lifelong process. It starts with your vision, moves to a calculated savings goal, is funded by various income sources, and culminates in a carefully managed distribution plan. It is a journey of 1,000 small steps, taken consistently over a long period of time. In our next chapter, we'll discuss the importance of building your professional team, understanding how your financial advisor, tax professional, and estate planning attorney can work together to support your financial life. Thank you for listening. Hello and welcome back. Throughout this series, we have focused extensively on the process of finding and working with a reliable financial advisor. Your advisor is often the central point of contact for your financial life, the architect of your financial plan. However, a truly comprehensive strategy often requires a team of specialists, each with a distinct and vital area of expertise. Just as a star quarterback needs a great coach and a skilled team around them to succeed, your financial well-being is best supported by a coordinated professional team. This chapter is about understanding the roles of the key players, the financial advisor, the tax professional, and the estate planning attorney, and why their collaboration is so powerful. As we will be discussing professions that operate in highly regulated fields, please consider our standing disclaimer. This information is for educational purposes only. It is a general description of professional roles and is not financial, tax, or legal advice. You should always consult with qualified, licensed professionals in each respective field for advice tailored to your specific circumstances. Let's begin by clarifying the role of your financial advisor. As we've discussed, think of your advisor as the architect of your financial plan. They are responsible for helping you see the big picture. Their primary role is to understand your life goals and then design a comprehensive, integrated strategy to help you pursue them. Their expertise lies in areas like goal setting, investment management, retirement planning, and risk management. However, it is crucial to understand the limits of their role. While they must be knowledgeable about tax and estate planning concepts to create an effective plan, They are not licensed to give specific tax or legal advice. This is where the second key member of your team comes in: the Certified Public Accountant, or CPA. The CPA is your tax strategist. Their world is the complex and ever-changing tax code. While many people think of a CPA's role as simply preparing a tax return once a year, their real value often comes from proactive tax planning. A good CPA can work with you throughout the year to help you structure your financial decisions in a more tax-efficient manner. They can answer critical questions like, what are the tax implications of exercising my employee stock options? Or how can I best manage taxes on my investment income? Their role is to look at your financial situation through the specific lens of tax law, helping you minimize your tax burden legally and effectively. The third member of this professional trio is the estate planning attorney. This individual is your legal guardian, responsible for ensuring your wishes are legally documented and can be carried out in the event of your death or incapacitation. While your financial advisor helps you accumulate and manage your assets, the estate planning attorney drafts the legally binding documents that govern how those assets are protected and transferred. As we touched upon previously, these are documents like a will, which directs the distribution of your property, trusts, which can manage assets for your beneficiaries, and powers of attorney for finance and healthcare, which appoint trusted individuals to make decisions for you if you cannot. The creation of these documents is the practice of law, and must only be done by a qualified attorney. Now, while each of these professionals is an expert in their own field, the real power is unlocked when they work together as a coordinated team. Imagine a scenario where they operate in silos, without communicating. You might tell your advisor you plan to sell a large investment. Your advisor helps you plan how to use the proceeds. But without consulting your CPA, you might trigger a much larger tax bill than necessary. Or, without consulting your attorney, the proceeds might not be correctly titled to align with your estate plan. Now imagine a collaborative approach. You tell your advisor you are considering selling the asset. With your permission, the advisor contacts your CPA and your attorney. The advisor can model the financial outcome, the CPA can advise on the most tax-efficient way to structure the sale, and the attorney can ensure the legal structure is sound. The result is a single, cohesive strategy where the financial, tax, and legal pieces all work in harmony. This collaborative approach helps prevent costly mistakes, uncovers hidden opportunities, and ensures that the advice you receive from one professional doesn't inadvertently contradict the advice from another. When you hire these professionals, you can give them express permission to speak with one another on your behalf. Building this collaborative team, with you as the central focus, is one of the most effective things you can do to manage the complexity of your financial life with confidence. In our final chapter, we will summarize the key lessons from our journey and offer some encouragement for taking the first empowered steps toward your financial future. Thank you for listening. Hello, and welcome to the final chapter of our series. We have traveled a long way together on this path to understanding how to find reliable financial help in the United States. We began with what might have been a sense of confusion or uncertainty, facing a world of complex terms and intimidating choices. Our goal throughout these chapters has been to replace that uncertainty with clarity, and to replace that fear with empowered knowledge. In this concluding chapter, we will look back at the key lessons we've learned and focus on the simple, powerful first step you can take today to begin your journey. Before we conclude, let us share our guiding principle one last time. This audio series has been prepared for educational and informational purposes only. It is not, and has never been, a substitute for personalized financial, legal, tax, or investment advice from qualified, licensed professionals. Our sole purpose has been to provide you with a map and a compass, so you can navigate the process of finding those professionals with confidence and clarity. Let's take a moment to reflect on our journey. We started at the most logical and important place, with you. We learned that the foundation of any sound financial plan is a deep understanding of your own goals, your current financial situation, and your feelings about risk. From there, we ventured into the professional landscape, decoding the alphabet soup of financial credentials, and learning the critical difference between various standards of care. We built a process for finding and vetting potential advisors, conducting background checks, and asking the right questions in that first crucial meeting. We walked through the process of making the relationship official, understanding the paperwork that seals the partnership. With a trusted guide in place, we then armed ourselves with knowledge. We demystified the basic building blocks of investing, like stocks and bonds, and the accounts that hold them, like 401ks and IRAs. We explored the vital role of risk management and insurance as the protective shield for our financial foundation. We saw how all these pieces come together in a holistic financial plan, And we even delved into our own psychology, understanding the behavioral biases that can influence our decisions. Finally, we learned that a financial plan is not a static document, but a living one. We established the importance of regular checkups, learned how to navigate major life events, and understood the power of a coordinated team of professionals working together on your behalf. If you were to distill this entire series down to a few core principles, they would be these. First, clarity precedes action. The most important work you will ever do for your financial future is the internal work of deciding what you truly want your life to look like. A clear goal is the most powerful motivator and the most effective guide for all subsequent decisions. Second, knowledge dispels fear. The world of finance can feel intimidating, but as we've seen, the core concepts are understandable. You don't need to be an expert, but having a foundational knowledge empowers you to ask better questions, understand the advice you receive, and be a confident partner in your own financial plan. And third, process is more important than prediction. The most successful financial journeys are rarely the result of a single brilliant move or a lucky stock pick. They are the result of a disciplined, consistent process, followed over many years. A sound process, like the one we've outlined, protects you from emotional decisions and keeps you focused on your long-term destination, regardless of short-term market noise. So, after all this, what is the single next step you should take? It is not to rush out and hire the first advisor you find. It is not to immediately buy a specific investment. The most powerful first step you can take is to return to the very beginning of our journey. Go back to the ideas in Chapter 1. Take out a piece of paper, open a new document on your computer, and simply start writing. Write down your goals. What do you want to achieve in 1 year? In 5 years? In 20? Dream a little. Be specific. This simple act costs nothing. It requires no special expertise, but it is the catalyst for everything that follows. It is the first, most profound act of taking control of your financial destiny. Thank you for joining us on this journey. Our hope is that you now feel better equipped to move forward, not with all the answers, but with the confidence to ask the right questions and the knowledge to find the reliable help you deserve. We wish you the very best on the path ahead.
Disclaimer. The information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.